I think the biggest misconception when it all came out, it's not just real estate. And not only is it not just real estate you can invest in, it's not just real estate capital gains that you can put into a QF. A lot of people think, oh, this is 1031 exchange. It's not 1031 exchange. You can have $1 billion of Bitcoin and liquidate that and put that into a QF. In fact, I do have clients who are staking crypto. That's their whole job, is to stake crypto for the next year and then liquidate on January 1st, 2027. And they could do that and then take those cap gains, put that into a captured QOF, take the basis, put it right back into the next staking deal, and they're paying no capital gains for 5 years.
Hi, and welcome everyone. Thanks so much for coming today. I'm really pleased to be joining you for what's sure to be a very exciting interview and dive into the legal world of opportunity zones structuring, the good, the bad, maybe the ugly. Let me introduce our interviewee for today, Michael Krueger from Lucosky Brookman law firm. Thanks so much for joining us today. Opportunity zone lawyer and legal strategist.
Thanks, Joe. Appreciate it. Happy to shed some knowledge and experience on what I've seen and hopefully what's to come.
You bet. I always like to start with everybody. We don't have to go super deep, but just a little bit about you, kind of your background, and then maybe segue that into how you got into the opportunity zone space specifically, since it's so interesting for this audience.
Yeah, thanks, Jeff. So I kind of took an interesting route where I am now. Straight out of law school in 2008, I was in Silicon Valley. Job market wasn't great, but I was able to snag an in-house counsel role with a financial firm that specialized in tax mitigation. So CEO is a guy named Andrew Rutger, who actually runs a lot of opportunity zones now. And our focus was on our American Recovery Reinvestment Act. So it was a lot of tax beneficial investments in solar panel companies and testing facilities. And I really cut my teeth on all things Silicon Valley, running up and down Sand Hill Road, and made a lot of long-term friends. And then shifted that into working with a lot of startup companies, a lot of businesses getting funded. It was right around the time Y Combinator was coming out. So if anybody's ever had a safe note or a safe agreement that they filled out, that all came out of those people. And it was really interesting to see how the market shifted from really the recession into about 2014, 2015, when I shifted over to a lot of real estate development, where a lot of my clients needed someone who could structure pretty creative waterfall structure, pretty creative operating agreements, things like that, that were attracting not just your typical real estate syndication, but more on the security side of how things were structured. And then kept doing that for several years. And one of my developer clients had a property in downtown Berkeley, which happened to be an opportunity zone. And he said, I want you to learn everything about this and become an expert. This is late 2018, early 2019. And it really wasn't even until spring of 2019 that we got the SEC guidance. We could actually say what all this is. And so from that point on, we were able to structure quite a few deals all through the opportunity zone regulations and really as a launch point to where we are today.
That's awesome. And so I know one of the things that you do, and everyone on the call is still getting to know you, which is fun, but you do a lot of work with high net worth and ultra high net worth individuals. I've heard, including some celebrities and athletes. I don't know if you can name drop. That's always exciting. But how is that maybe applying to what you're seeing now in the opportunity zone space? Is there any connection?
Yeah, it's interesting because in representing a lot of my professional athletes, a lot of times they have their own financial advisors. They may have their own business team, and then they get brought these opportunities for endorsement deal. Some of it involves an investment into the deal. Some of it is just, hey, I'm going to give you equity to endorse this. And so they ask me, hey, can you structure that? So in doing that, it's often what we're seeing now with a lot of QOFs and family offices, where the individual that they want to bring into the deal, either from an investment standpoint or some value add, I'll do that deal, but then down the road, I'll become that company's counsel. So what happens a lot. A lot of my professional athletes are in some franchise agreements, and that becomes rather complicated. And so I shift from just representing the individual investor into the company, become company counsel. We have some really cool things happening down in Atlanta right now. In fact, just today, I found out that Glenn Robinson, the Admiral, he's going to be coming into one of our deals. So name drop a little bit there. I don't represent Glenn Robinson, but he's He is going to be in one of our deals now. So that's going to be pretty cool. But what that led to is kind of what we're seeing right now, where I'll have a really good developer who's working with a really good QOF or a really good family office who doesn't have a QOF. And I'll bridge that gap and I'll say, look, this is what the QOZB structure is. These are the benefits. This is why you have a QF set up. This is how you want to move forward with it. You have your own counsel who can review everything. And they say, great. Now we did your deal, but we want you to help us out with future deals. And so I'll kind of be wrapped up as the QOF counsel for the family offices. And I think we're going to see a lot more of that as we move forward with OZ 2.0, to be honest with you.
Sure, that seems valid and wise for that matter for them to seek that coverage. It's interesting to me because I know if you read your bio, you're a securities attorney. In your experience, is this all just real estate that you're dealing with on the opportunity zone side, or how is that penciling out for you?
Yeah, I think that was the biggest misconception when it all came out, that it's not just real estate. And not only is it not just real estate you can invest in, it's not just real estate capital gains that you can put into a QF. A lot of people think, oh, this is 1031 exchange. It's not 1031 exchange. It's not a DST. This is not, I could spend another 3 hours on why I don't like 1031 exchanges and why this is better, but there are some reasons 1031 exchange is good. But this one is, you can have $1 billion in Bitcoin and liquidate that and put that into a QOF. In fact, I do have clients who are staking crypto. That's their whole job, is to stake crypto for the next year and then liquidate on January 1st, 2027. And they could do that and then take those cap gains, put that into a captured QOF, take the basis, put it right back into the next staking deal, and they're paying no capital gains for 5 years. So that's a little bit of future planning, but that's one of the biggest differences between 1031 and what this is. But to answer your first part of the question, I have many clients that are started businesses that are QOZBs. We're working with a new one that's a locomotive manufacturer, which kind of taking 21st century tax laws and applying it to like 17th century technology, but we'll see how that goes. But I think it's actually going to work out really well. But the point of all this is you can have any business that's going to have separate rules and regulations to how it qualifies as a QOZB, but it's not just real estate. I have a company that all they do is invest in solar rooftop. The rooftop solar equipment itself is the QOZB. They're installing it on houses that are in QOZBs. So there's many different ways they qualify for the QOZB status, and they're getting all the benefits of the extra tax credits that seem to be going away on the solar. But the point of all this is it's not just real estate. It is always a security though.
Yeah, and I think that's a common misconception. It's interesting that you identified that so early. I know that we're kind of in this weird nebulous transition from OZ 1.0, who, if anyone on here is just getting into the opportunity zone space, we're in this crossover period where the big beautiful bill came out. There's this opportunity zone 2.0. And some of it's very clear when it all started. Some of it's a little mushy. We're getting it all fleshed out. I know, Michael, you've actually been in some of that conversations. We had a chance to talk before this. But what did you see from legally, at least, what were the legal topics from Opportunity Zones 1.0 that showed up?
I think the biggest misconception and biggest issue that we saw from a legal standpoint was actually structuring the QOF and the Qs. I think a lot of people thought they were the same thing. I think a lot of people thought all I have to do is invest in the QOF and everything's fine. And that wasn't the case, clearly. It is possible to invest directly into a QOF and hold qualified opportunities on business property. Some people do that, especially on startup companies, but there was something and still is something called the 31-month safe harbor. And that's a really big part when it comes to real estate. So if I'm a developer and I'm tearing down a building and it's just a vacant lot, I've not substantially improved the asset. And that's one of the requirements to do to the actual property to satisfy the requirement of a qualified business property. And if I didn't have the QOF and QOZB set up properly, I just said the QOF's going to own that, there's no safe harbor for the QOF. And now that's a lot of people messed up. The other thing that I think people misunderstand or don't do properly is they mistaken the 90% rule and 70% rule. So on the QOF level, we'll just say the fund has a requirement to invest 90% of those funds into qualified business property. qualified opportunities on business property. But that means they can take 10% and do whatever they want. Sometimes though, they get a little too close to that threshold and they don't invest 90%. They invest like 88% because they forgot there's some other expense or something. Another thing that often happens is they don't invest that QOF fund within 180 days. That's the biggest one that we're seeing. We're seeing them put money into the QOF, but not deploy it into a QZB with 180 days. But luckily, and this is happening to a few of my clients, it's not a fatal mistake. You just pay a penalty and you eventually can deploy that. So you do pay a certain penalty on that. You get the funds put in, and then that stops the bleeding. On the QZB level though, you have 70% rule. That means 70% of the funds have to be deployed for that business purpose. And there's additional requirements as well. It can't be a golf course. It can't be other specific sin businesses where there's like 7 or 8 that are listed there.
Right.
I have seen it where a hotel property is acquiring a golf course. And I say that's great on the hotel property, but it's not the golf course that doesn't qualify. But just as the QF didn't have a fatal flaw, if you don't have 100% of the assets in the QZB as qualified business property, it's not a fatal flaw. It just means you can't apply it to the golf course. You can still apply it to the hotel. But one of the other issues we're seeing in the QZB is we're not seeing them actually do anything. You cannot do anything and it's fine. But the only way you can not do anything and be fine is if you actually plan to not do anything.
Right.
And I know it sounds counterintuitive, but you have a 31-month safe harbor to say, look, we can't really do anything right now. We're waiting for permits, we're waiting for entitlements, or there is a fire or something else. Keep in mind, natural disasters and other things that kick out tax dates, like you'll see in the IRS that, especially for people on California coast, the LA fires extended their tax filings. That's also like a stay. Like if you're in a court proceeding or if you have a tolling of statute of limitations, you have a tolling period or a stay that kicks those dates out. I'm getting a little bit into the weeds here, but the point of all of this is there's a way to do this the right way and a way to do it the wrong way.
Right.
And I've spent probably the last 6 months helping a lot of people that didn't do it the right way get it back on track, as well as a lot of people setting up new ones. But we're definitely seeing a resurgence in utilizing opportunity zones. I don't know if it's because 2.0 came out, there's more interest in it, or if it's just because we're seeing the market kind of shift. A real good real estate guy I know says you don't want to build on cycle and sell off cycle because you'll miss it. You want to build off cycle, or you want to build on cycle and sell off cycle. So you're structuring it the right way.
Yeah.
So I think what we're seeing is people trying to raid shop. They're trying to chase a certain amount of new equity coming in. But I think there's also a situation right now where we're seeing just fatigue, and not fatigue in the sense that you're seeing deal fatigue where people are chasing so many deals and deploying. I think it's not FOMO. It's not a fear of missing out. I think it's just all right already. It's rate chasing fatigue, I think is what we're seeing, where they're saying, okay, who cares if we could have had a 1-point reduction, that we can still refinance that once we get to that point. Let's just pull the trigger and get the deal done. Because the alternative now is those who participated in OZ 1.0, they don't get the long deferral. And that's kind of a big problem, I think, for the future is if I have a capital gain right now, I still have to pay that at the end of 2026. I don't get that extension. That's what a lot of people thought was going to happen with 2.0.
Right.
And since it didn't, I think people are saying, well, what the heck? Let's just do it now. It's still a great deal. We're still going to have good tax mitigation here. We're just not going to get as good of a deal as we thought. But we're going to probably have future capital gains. So we're going to take advantage of it in the future, and we're going to know what we're doing here, and we're going to have everything set up. So I think that's what we're seeing right now.
That's excellent. Well, and how fortunate for those clients to get that kind of advice from you. Because similarly, we've all heard the horror stories of people doing things that did or didn't work. On the 1.0 end of things and kind of all the experience now that you've had, what did you see out there that did work specifically? Like what felt like it was optimized and aligned?
Yeah, no, that's great because you want to say what worked more than anything here. And I think what really worked was the deals that were already good got much, much better. So for example, my client in Berkeley does mostly student housing deals. Those are home runs. I mean, especially that they're right downtown Berkeley. You can walk to campus right there. And keep in mind, you have to know what you're doing as a development sponsor, regardless if it's an opportunity zone.
Right.
This guy specializes in area. And that's why, these were relatively large QOF funds, large fund managers that came and invested right alongside it. And they invested in several with him. And that's because he knows what he's doing. He's a good sponsor. Now we're dealing with the refinance of those. So it's very interesting to see what some of these 1.0 deals were coming into refinance stabilization. You're probably still going to come in a little short. You're going to need to do a little bit of a capital call. But what's working, I would say, in addition to that deal working, what's really working is the leverage you have for completed projects that haven't been depreciated yet. And
Right.
so that is kind of the real sweet spot that I don't think we're going to have this opportunity much longer. I think it's probably from here till the end of 2026, and that's it, where you can invest as a QOF fund into a completed project that they don't have their certificate of occupancy yet. They're not leased up yet, or maybe they're partially leased, but nothing's been depreciated. So there's a way to do that where you can take all the development risk out, come into, we'll just say, a reset of what that valuation is, and move forward making coupon clipping cash day one. So it's kind of a cool opportunity I'm seeing right now. So the ones that I have seen are good sponsors, good developers who know what they're doing, that were adequately capitalized, that built in a reserve, and also are still attracting other investors, even right now when the rates are not as attractive. Other things that I've seen work very well are a lot of these startup companies. So the risk level, you're going to have a higher risk tolerance anyway for startup companies. But the key thing about investing in a QOZB, that's like an incubator or a startup company, is you can sell the QOZB as many times as you want. As long as you're not distributing that on the QOF level, you're still fine. So if the QOZB doesn't survive 10 years, who cares? You just roll that in within 180 days of another QOZB. And I think we're going to see that taking off. I mean, tremendously after 2.0. And the reason is because I can set up 20 different startup companies in a rural zone, get a 30% stepped up basis on that investment alone. And if they're heavy equipment, I can do all the 179 bonus depreciation, or I do the bonus depreciation and any 179 deductions, all that stuff, and really maximize my benefits there. So I think we're going to see a massive shift towards startup investment, just private equity, and essentially all these family offices turning into a QOF private equity division. And that'll be really interesting.
That's huge. Well, yeah, it's so interesting to think about where this could all head and how a lot of these ventures are going to thrive as a result. And that's really optimal for even for these rural areas. So, going back to the same question, let's go to the other side, the dark side of the moon here. What did you see that didn't work from 1.0?
Well, I mean, obviously some of the deals were just not levered very well, or they were over levered, or they had too many assumptions like, oh, rents are going to go through the roof and rates are going to drop dramatically. The other thing, to be fair, I mean, in 2019, even early 2020, nobody knew COVID was going to happen. I remember having a speech at my previous firm, and we were down at the Canyon Club in Orange County. And I was talking about how brilliant Zynga was for doing a sale leaseback. And I was applying it to opportunity zones, saying, man, they sold this huge asset for like $600 million. It went straight on their ledger. It looked amazing. Now they're leasing it back. That was February 2020. And then a month later, everything shut down. And so nobody knew what was going to happen. But even on that situation, Zynga's stock was going down quite a bit. They made a good business move. So the ones that made good business moves, regardless of what was happening, were always going to be fine. But even the ones that thought they were making good business moves, I'll tell you, there's some properties down in Florida that they didn't understand what they were doing. They had CPAs telling them one thing. They were telling their attorneys, oh, this is how it has to be. There's a miscommunication. And now you've got 3 or 4 different entities between the QOZB and QOF, and none of it qualifies. So I would say the horror stories are going back to some of these people saying, it's what you did was fatal. We can't fix it. The ones that are fixable are fine, but it really comes down to the structuring. Did
Yeah.
you structure this entity the right way? A lot of people thought they could make disregarded entities. It could just be a husband or wife entity. Hey, it's an LLC. It's a husband and wife. They messed that part up because they didn't have the proper structure. Another thing is, and this is more corporate business 101, which is just commingling assets. They didn't set up bank accounts. They didn't do separate entities the right way. And unfortunately, they had some issues. And some of the investors came back and said, we want a rescission. We want to do everything this way. One thing I will say that was common in the ones that made the mistake is they thought this was a real estate syndication and not a securities investment. And that's one of the things that at my firm, Lucosky Brookman, we are a very, very good securities firm. We do a lot of micro cap stuff. We do a lot of uplistings, but first and foremost, we're a securities firm. We understand all of these rules and regulations. And I can't tell you how many times I saw somebody say, oh yeah, we did a 506B and, we blasted it out. We got all these people coming in. And I said, okay, so you did a general solicitation under a 506B. Was everybody accredited? Nah, we don't know. I'm like, okay, we have some problems there. Or maybe they didn't follow blue sky rules, or maybe they didn't do a Form D. So all the typical things that you would have to do on a securities investment. And they just didn't because they thought this is real estate. And the SEC was very clear, absolutely clear early on that this is not a real estate investment. This is a securities investment. If you're doing a QOF and do a QOZB, even though you may have certain exemptions, it's a fund into a securities. So that's really what I think we're going to be focusing on a lot. It's what we do in our operating agreements and corporate docs for investments coming in, but make it absolutely clear. The other thing I think people made a mistake is they didn't understand what a fund is. They thought it's just an investment pool. It's not. It has other additional requirements you have to have. You have to designate yourself. You have to say, we're a private fund. We have certain exemptions from reporting. Now, the reality is they're not going to get dinged, most likely, if it's a small amount. But if you have these pretty big funds out there that are raising hundreds of millions of dollars, and they didn't set it up the right way, or they didn't even think that, oh, we need to check the box that we're exempt fund, or we're exempt from the 40 Act because we have certain exemption rights, it's just sloppy. It was just sloppy. And that's easy to fall into on something new like this, where you think, oh, well, we've never done it this way before. We've always done it this way. I'm sure it's going to be the same way. It wasn't the same. So those are the horror stories. And I'm glad to be moving out of those.
Yeah, I'm sure. Well, and I've heard, we've all heard, of course, that the reporting guidelines and of course the penalties are getting ratcheted up for 2.0. And I'm thinking that's a reflection of a lot of this. It's really just an understanding at the level of the bill that we got to clean things up. So I've heard about a lot of massive mistakes out there, especially with, let's call it what it is, well-intentioned, but maybe not prepared service providers who've come into the opportunity zone space saying, I can help you. And maybe they can, many, and some are underqualified, if not qualified. Are there any kind of service provider horror stories that you've seen or could reference out there?
Yeah, I mean, I don't want to throw anybody under the bus, but I would say there are a few very large funds in the South Bay of the San Francisco area that are probably going to be seeing indictments in the future. And they promised the moon, and they said, we're going to do all these things. Just put your money with us. Everything's fine. Puppy dogs and unicorns. And then they turned out they just couldn't deploy the capital. So I think what we're seeing is the service providers that come in and say, I could raise you capital. I personally will raise you capital. Those are ones where you want to ask right away, okay, how are you legally allowed to raise capital for it? We see that a lot, and not just in opportunity zone space. We see that at any start. Other people who say, I will do this for you, and I will be in compliance for the duration of your deal. And he said, okay, well, how do I know you're going to be able to provide this for me for the next 10 years? What's your strategy? What are your service? Who you're connected with? And they don't have a relationship with a good tax group. They don't have a relationship with a law firm. They're just a middleman or a middle person out there that says, oh yeah, I can do this for you. So I think the ones that are the biggest issues are the ones everyone should know right away. Like if someone's guaranteeing that they can raise capital for you for a fee, That's very rarely accurate.
Right.
But I would say if you need help raising capital for your QZB and you need it through opportunities on funds, or you don't even care about contract, just go hire a broker dealer. That's exactly what they're there for. It may cost you some money up front. It may cost 5, 6, 7% of the raise, but it's perfectly legal if they're a licensed broker dealer. Our firm works with broker dealers all the time. Anytime you're dealing with a big IPO, anytime you're dealing with any big pipe or M&A deal, there's more often than not an investment bank or broker dealer. So all this stuff's very above board if you're dealing with the right people. But
That's right.
just ask for their credentials. That's the way you avoid a mistake.
I love that. Well, and such sage wisdom. It reminds me of when the gold rush happened in the United States. The people who made the most money on the gold rush were people selling pickaxes and wheelbarrows. You got to be careful and make sure that you're really vetting your professionals. So that's where we are now. We've kind of gotten up to this point. How are you seeing things going forward? What comes next? If we have the Michael Krueger crystal ball here, what's coming next?
So I think we know what's coming in 2027. The real gray area is what's coming between now and. As I mentioned earlier, we had multiple rounds of guidance from the IRS on OZ 1.0. We haven't had any rounds of guidance on 2.0 yet. And that doesn't mean that things are going to change fundamentally, but I think we're going to get some clarification. We're going to get some more guidance, say, this is what this means. The one area that I believe will be changed, and this is not what it currently is, but what I believe will be changed, is if right now, if I take an investment, if I liquidate my asset investment and I have a capital gain, I have 180 days to deploy that to a QOF. That's true. But if I put it in a QOF today, I don't pay any capital gains until the end of 2026, which means April 15th, 2027. That's when the tax bill comes due. That's understandable. That's fine. But if this is 2026 next year at this time, I do the same thing. The IRS or the current guidance says, no. That's 1.0. You don't get 180 days. Your tax is due at the end of this year. So that's what it says right now. That's what I think has to change. And the reason I think it has to change is I don't think this was ever the intent of Opportunity Zone 2.0, because even I could see them saying any investment in Q1 or Q2, meaning up to June 30, 2026, you're not going to get the benefits. But anything after that, it would be contrary to common sense and logic to say that 180 days somehow is severed. You don't get that 180 days to go into 2027. So I do think that's going to change. But to be clear, and for everybody who's listening right now, the rule right now is even if you have a capital gain on December 31st, 2026, that capital gain counts for 2026. It doesn't count for 2027. That's how it is right now, which I don't think makes sense, but that's how it is. So when I'm saying, what do I think is going to change? I think we will get more guidance, but that's the only little hiccup we're running into. 2027 comes around. It's a game changer. And the reason it's a game changer is because of really three things. The first one is 5-year rolling deferrals for everyone. I feel like Oprah, you get a 5-year deferral, you get a 5-year deferral. So everyone gets 5-year deferral. And that means that the capital gain tax that would normally be due is kicked out until 2032 if it's 2027, 2033, et cetera, et cetera. So you get 5 years of no cap gains. And then the investment that I make into that QOF, I will get a stepped up basis. Now, stepped up basis depends on how long you hold it. Also depends on where you deploy it. If you're a QZB in a rural area, which they just came out with clarification guidance, which they didn't really clarify. They just said, this is what it is. It's a population of 50,000 or fewer. That's what rural was before. That's what rural is still. They just clarified that. So if you have a QZB located within a designated rural zone, you will get a 30% stepped up basis. So not only do you not have to pay taxes for 5 years, you're only going to pay 70% of that tax bill in 5 years. That's massive. That is absolutely massive.
Huge.
If it's not in an opportunity, if it's not in a rural zone, you still get a 10% up basis, which is still amazing. It's still, you're only paying 90% in 5 years. If you can't find a way to pay that capital gains over 5 years by some other investment, I don't know if you're on the right call, because most people around here are pretty smart about how they can invest that in and offset that tax. So those are the two really big ones that jump out right away. Now, the other things that I think are going to get really, really interesting here is when we start looking at rolling over deferrals and kicking things out. So now we made these permanent. So there's no sunset down the road. If I have that startup, the discussion we're talking earlier,
Right.
and I have an appetite for starting up businesses, why wouldn't you set up an incubator in a rural zone? I can give you a list, or anybody can create a list of all the universities in rural zones where you could be plopping in opportunity zone incubators that are going to get a 30% stepped up basis for your investors. And even if you spread it out over 100 different startups and only one of them pops, you just keep on doing that. You keep rolling it over and rolling it over. So the rollover part is what I was a real big proponent of on opportunities on 1.0. I'm even more of a proponent of it on 2.0,
Makes sense.
which is again, it's why those service providers you're talking about before, you don't want to be locked into a deal where the person who put you in that deal, that service provider, is incentivized to do that. You don't want them saying, no, you have to lock in here. You want to have the freedom to say, no, it was a good opportunity. I liquidated my assets. I rolled it over. When we're looking for alignment, we're looking for alignment of interest. It's not necessarily a QOF fund manager that comes in and says, okay, I'm going to be your fund manager. You're going to put money into this fund. I'm going to charge you a 2 and 20 or whatever. And I'm going to choose everything. And you're not going to get a say in anything. I mean, those are out there.
Sure.
Those are some of the ones I talked about that are going to be indicted. But what I would recommend, especially if you're a family office, especially if you what you're doing, you just engage a service provider who can be an addition to that. You don't want them to necessarily be your investment advisor. You don't need them to be your investment advisor. You need them to be your QOF compliance advisor. Same thing on the QZB. I work with so many different developers, and what I have found is you need a QOZB QB. You need a QOZB quarterback who can handle the compliance period, because that's the one that has the 10-year period.
Sure.
Even if they liquidate it before 10 years, that QOF can go throw it over to someplace else. But you want to start with the intention for being compliant for 10 years.
Right.
And if you don't have it on the QZB side, you're never going to attract your investors. You're never going to be able to bring in people that say, okay, I trust you. I know you're a developer, but what you're doing on the opportunity zone side? I mean,
Right.
who's your CPA? Who's your law firm? Have they done one of these before? Another great thing. If people haven't done one before, it doesn't mean they can't learn it, but if they haven't done one already by now, and they didn't just start their business a week ago, I don't know if I'd go with, because I mean, there's no reason to become a QOZB expert tomorrow. I mean, there is a reason to do it. I'm just saying, if you are relying on somebody who hasn't done this before, just say, look, you can be my attorney. You can be my CPA for everything else. I just want to bring in somebody who just can answer this very important question, because there's a lot of taxes that are at stake if I do this wrong.
Yeah, that makes a lot of sense. You had a couple of questions that showed up live here on the call, and I know we're coming up on time here, so I'll take just a quick moment. One of them was from Cynthia. Thanks for being here today. Who said, "Can one invest in?" And I think you may have answered this, but in both startup companies and businesses versus just real estate. And I do recall you answering that. Did you want to add anything?
Yeah, Cynthia, thanks for your question. I would definitely say, yeah, of course you can invest in the startup. You just need to make sure that the QZD you're investing in as a startup, they have the intention of at least out the gate saying, we're going to be holding this for 10 years, or going to be a business, and they satisfy all the requirements. Following back up on one of the points Jeff raised is, whenever you can, and this is just what lawyers do all the time, if someone else is going to make a rep and warranty, make them make the rep and warranty. There's no reason for you to just go along with them. When you're looking at a contract, it should be a subscription agreement, there should be PPM, there should be everything else that says, these are all the reps and warranties. And one of those reps and warranties should be, we are a qualified opportunities on business, and this is how we qualify. And that's one way to satisfy that. But there's another wrinkle to that, Cynthia, is not only can you invest in the startup business that's located in the opportunity zone, you can invest in the real estate, in the building that they're there, or you can say, look, we don't want to just invest in the startup. We want to invest in the whole thing. the real estate, everything. And that often is a good play for setting something up that way.
Nice. Yeah, that makes a ton of sense. The next question that we had, we have two more, was would a bar, first off, and or a hospitality or entertainment business likely pass as a QOZB? Or how do you see that structurally work?
Yeah, I think if it's actually a restaurant, if it's a restaurant and not just a bar or a liquor stores, they don't pass. And if it has to be 50% or more of your revenue. So if you're a restaurant, I'm sorry, I'll read the question. Yeah, I mean, it can't be a casino. It can't
Sure.
be some other thing. Then there's the whole list of what doesn't satisfy. But at least in California, I know that the liquor licenses are designated. You can have a restaurant and bar. So if that's how it's set up, your liquor license is actually a good exhibit to how you qualify. So if it's not a standalone bar and you say, no, it's not a standalone bar, it's a restaurant with a bar, then you're fine now. As
So,
long as there's no casino in it.
well, and that makes sense. It kind of goes to those sin businesses, and I'm sure you can just go online and type that up, and you'll get some very interesting Google results. So, somebody asks, I have a large capital gain coming up early next year. I need help with all things OZ, including how to find a good investment strategy or strategies. Can you help with that, or exactly what would you recommend that this person do? It's an anonymous question.
Yeah. Anybody who's got a big cap gain coming in, I mean, what I would recommend is set up a QOF for yourself or talk to somebody who has a fund that they're controlling that aligns with your interests. So you do have some time. Again, you have 180 days to deploy that to a QOF. So I'm happy to help you on the legal side. I do not provide any investment advice. That is, I will say that in all caps. I do not provide investment advice. I can't say this is a good investment. This is a bad investment. I will just say, this is how you are compliant. And I can hand you off to a handful of other people who would be happy to make a rep and warranty that do say this is a good investment.
That makes a lot of sense. The last one that we had here, this looks a little maybe niche, so we could always put a pin in it if we need to, but does the presence or contemplated future use of the NOZ strategy affect purchase of industrial facilities, real estate, or machinery and equipment that's at least partially funded by state or federal grants? It's a lot.
Yeah, there are all those things that came out in the big, beautiful bill. What I will say is it's not a QOZB for this. There are some certain structures that you set up where if it's passive, you don't get certain losses, or
Right.
if it's active, you don't get certain losses. So there's certain limitations in how you structure that. So that goes back to the good CPA and good attorney to answer your questions and to set up your investment with those intentions. If some people are just saying, I don't really care about the depreciation or reductions, I just want to have a real big pop in 10 years and I'm happy. That's one thing. One thing I will circle back that we didn't touch on is a lot of people that weren't real estate investors or didn't know equipment investing didn't know that the depreciation recapture is such a big benefit in opportunity zones. So what that means is if I invest in a deal right now and I take all the depreciation up front, it's usually supposed to amortize over a certain amount of time. And so if I sell that after 10 years, normally they would say, okay, you sold this, but there's the depreciation recapture element. So anybody who's done a real estate sale, you'll see that line item. Opportunity zone says, nope, poof, gone. There's no depreciation recapture in opportunity zone. And that
Right.
also continues to 2.0. So that's a biggie, especially on hotel investments. Same thing with this question about heavy equipment. Anything that you're investing in that has other incentives that are huge, that really can make a good deal super attractive on the depreciation. There's no recapture if you hold it for 10 years in the QO.
Yeah, pretty remarkable when you start aligning these things like the non-depreciation recapture or the 30% stepped up basis, and you start stacking these benefits and it just becomes pretty remarkable. Any parting shots? I think we're right at time here. Really appreciate everything that you had to say, but if people wanted to get a hold of you, or if they had additional questions, is there a clear, easy path for us to send them your way?
Yeah. You can put my email up. It's just mkrueger at Lucosky or luckbro.com. That's the easiest way to get a hold of me. I do a couple more of these presentations throughout the year. I'll be in New York. Our office is New York, so I'm there a lot. We'll be in New York City on November 5th. We'll be doing meetings at the family offices there on November 4th, 5th, and 6th. And yeah, we're kind of all over the place right now with really big deals. I will say this, infrastructure deals take a lot of time, a huge amount of time. And the new map of the new designated zones won't come out until July 1st, at least July 1st. In fact, I think the rules are the governors have 25 zones, so they can just pick. They can add 25 zones. That's how it was
Yep.
in 1.0. That's how
Yep.
it is in 2.0. So the governors have to submit their picks that are in addition to the low income housing and whatever the original designation was. I forget the specifics, but they have 25 new zones. So now is the time to be lobbying. If you have a big infrastructure project and you want to get it approved, you need to be lobbying your governor to say, this will create X amount of jobs. This will do X amount of things for the environment, whatever the main motivating factor for that OZ, you want to get those in as soon as possible, because after June 30th, 2026, that's not changing.
Right.
And we don't know if that's going to change 10 years from now, 20 years from now. There's no guarantee there's going to be opportunities on 3.0. So that's the map. And I think that is more important than I think a lot of people realize, is as we see migrating patterns from post-COVID life to what's happening with just job creation and where people are moving. That's going to be a big deal. The other thing I will say is the existing maps are still good until December 30th, 2028. So just because your opportunity zone disappears, you can still invest in that OZ up until December 31st, 2028. It's still fine, still works. Everything's still good there. That's another reason to plan ahead and really get things moving forward.
Well, we put your email address here in the chat for anyone who wanted to ask additional questions, or if you didn't get your question answered, I'm sorry if I missed anything. Feel free to reach out directly and obviously get that guidance. And Michael, thank you again so much for your time. Awesome session. And I know everybody here, like me, really appreciates all this kind of tales from both sides of the equation here. So thanks again.
Yeah, my pleasure. Thank you.
All right, everyone. Have a wonderful day. Thanks so much for joining us.